Hi, I'm Molly Nelson here with Clint, Huntrods, and Loren Merkle. We're going to get right into trap number 2. And risk is a really interesting, conversation as you're heading into retirement, Loren.
It really is. It's a really important conversation because you have to start looking at risk way differently than when you did when you're in the working world. So when you're 30 years old and your portfolio is down 50%, kind of like what happened to most people in 2008, it's not fun, but you have a lot of time on your side. It's not going to derail what you're trying to do from a planning standpoint. When you're 62 and you're trying to retire within the next 12 months and you lose 50% of your portfolio, then that could really derail and has derailed a lot of people's retirement. So when you approach retirement, you have to be way more intentional with the amount of investment risk that you're taking, and you have to have a reason, a purpose behind the construction of your portfolio and be really on point with that investment risk.
Loren, we've had a lot of families we've gotten to know for the first time, and when was the last time they set their risk parameters? In many cases, it was decades ago.
Yeah.
And things have changed, life has changed, their investments have changed since then, but they don't always go back and check in on that or adjust it over time. That's so important.
Well, when we ask people, we say, how much investment risk are you taking right now? There is rarely a good answer. A lot of times people will come back and say, well, I'm moderate. I'm taking a moderate. Well, what's that mean? Your moderate amount of risk, your moderate amount of risk, mine is way different. It's very subjective. And that's what I mean when we say we have to be more intentional around what we're doing with risk, and we can't look at it as conservative, moderate, and aggressive.
Well, I'm going to pick on you guys for just a second,
boy, here we go.
Because you financial types, I'm not the licensed professional, so I could pick on them for just a minute here. You do these risk assessments with people, right? And I was reading some of them online, and they have terrible multiple choice answers. Like, for example, it was something about with investments, what do you like to do? And one of the choices was, I am willing to accept above average risk to achieve above average investment returns.
Right.
Well, yes, please. Of course I am willing
Especially the above average returns.
Yeah.
Right? Let's get those.
Another one of the multiple choice answers that I could choose was, I am well informed about investing in personal finance. Well, who's going to admit if they're not, by the way? And I don't know what well-informed is. I'm not as informed as you guys, but there was such an ambiguity and
There's a lot of subjectivity
to these assessments. So not only has it been a while maybe since someone has done an assessment, I don't know how great most of the assessments out there are.
Yeah, that's why we like to get down to a number. What could this portfolio, the way that it is currently invested, do if you were to go through a big market downturn? And are you comfortable with that? And that starts to give us a lot of information on how you interpret risk. I mean, that's where we want to have a conversation, not see A, B, C, or D on this assessment. We want to have a conversation about how you feel about market risk. When the market goes down, does that keep you up at night? We want to make sure that you're taking a comfortable level of risk to meet some of those goals that you have in your retirement plan, but not taking too much risk where if the market goes down, you're going to be losing sleep at night.
Yeah, because nobody really knows what an aggressive portfolio means. But if you have $1 million in your retirement portfolio, and based on the way you were invested, we go through a downturn in the market, your portfolio is anticipated to be down by $300,000. Now you know what that means. And now you can answer the question based on your preference. Are you comfortable with that type of movement? Realizing nobody likes to be down, right? And nobody really likes to be down $300,000. But when you take risk, you have to be willing to tolerate some downturn. Is that tolerable? Is that really going to disrupt your plan? Or are you comfortable with that? Answering those questions is really important part of your overall retirement plan.
And that's exactly how you can avoid the trap. You can know in numbers what will happen. You just did this with a family. You sat down and you looked at their 401k and really helped them understand how much risk they were taking.
Yeah, we actually had a couple, and in their particular 401ks, the husband had a 401k, the wife had a 401k, and they had both just chosen the target date funds. And when we did some of our risk analysis, it showed that one of those target date funds where they're going to retire this year risk scored from 1 to 100 in the mid 70s. And they said, wow, that's a lot more equity exposure than I thought I had there. The other member of that particular family who also invested in a 2025 target date fund the year they were going to retire was actually more like a 50. And so even as you're looking at the 401k options that maybe you have, you might not know what that means. And company to company, 401k plan to 401k plan, they could be very, very different.
And that's why a part of the overall plan, we will help our families with their 401k plan. And a lot of times that's a surprise to our families because their past advisor didn't. That's their 401k plan. The advisor's focused on the investments that they're managing. but it is such a big part of their overall investment performance and retirement plan, it needs to be a part of that overall plan. So instead of the target date fund, the target date fund might be appropriate, or is there a more custom type of portfolio we can create within the 401k plan? But regardless, you need to understand how much risk is associated with that 401k plan, and then you have to be comfortable with it, and it has to fit within your plan.
And that can really lead into when you turn 59 and a half, depending on your plan provisions, you likely have the ability to roll that out into an IRA. And then instead of having that limited 15 to 25 mutual fund options in your 401k plan, you can have the entire array of the market to choose from. You can get a lot more strategic about risk and some of the different investment options that you can have once that's out in an IRA.
So let's say someone did find out they were taking unintended risk. One thing they can do is change things within the market. Do you find sometimes you take some of that money out of the market, or advise them to do that and put in some other kinds of investments?
It really depends. Unintended risk could be they're too aggressive or they're too conservative, because we do find that as well. Really what most families who are looking to retire or in retired are looking for is they want to beat taxation, they want to beat inflation, and then they want to grow it a little bit on top of that. But some people, a lot of people are different. They want to do something different. So yes, we need to make some changes. Maybe that involves taking some chips off the table. Maybe it involves putting some chips onto the table, just dependent upon where you're at within your overall retirement plan, what your retirement plan looks like, and how much risk you feel comfortable with and that you need to take.
So really the takeaway, the best way to avoid this is to understand what risk you're taking in real numbers, not some arbitrary A, B, C, D, and then decide what moves you need to make.
Yeah, clarity is kindness, and you have to be really clear about the type of risk you're taking and how much you need to take to accomplish your retirement goals, and then you have to make sure that the portfolio is structured like that. And it's not a set it and forget it, because things are constantly changing. The economy is changing, the markets are changing, your life, your goals are changing. Your investment portfolio as well as your retirement plan needs to change with it. So we need to set it, but we can't forget it.